If you ever opened an investing app and felt overwhelmed by the choice between buying a single stock or something called an ETF, you're not alone. This is one of the most common questions beginners ask, and the answer actually matters a lot for how much risk you're taking on. So let's break it down simply with real examples. Let's start with individual stocks. When you buy an individual stock, you're buying a tiny piece of ownership in one specific company. For example, if you buy Apple stock, you now own a small slice of Apple. Your investment goes up when Apple does well, strong iPhone sales, good earnings, new product launches, and it goes down when Apple struggles. Your entire investment is tied to the fate of that one company. If their CEO makes a bad decision, if a competitor releases something better, or if there's bad news in an earnings call, your money feels it directly. There's no cushion. It's just you and that one company's performance. Now let's look at ETFs, which stand for Exchange Traded Fund. An ETF is basically a basket that holds many different stocks at once, but trades on the stock market just like a single stock would. The most well-known example is an S&P 500 ETF, which holds shares in all 500 of the largest companies in America, including Apple, Microsoft, Amazon, and hundreds of others, all wrapped into a single investment you can buy with one click. But ETFs aren't just for broad market exposure. There are ETFs for specific sectors too: technology ETFs, healthcare ETFs, even ETFs that only hold renewable energy companies. So you can still focus on an industry you believe in, just without betting everything on one single company inside that industry. Here's where the real difference shows up: risk. If you put all your money into one stock, and that company has a bad year, your investment can drop significantly. You can see this clearly if you pull up a chart of almost any individual stock. There are sharp spikes up and dramatic drops down, sometimes 20 or 30% in just a few months. That's the nature of betting on one company. Think about companies that looked unstoppable and then completely collapsed. Some have lost over 90% of their value in a single year after a scandal or a failed product. That's the real risk of putting everything into one stock. Now compare that to a chart of the S&P 500 over the same time period. You'll notice the line is much smoother. There are still ups and downs, but they're far less extreme, because losses in one company are usually balanced out by gains in another. If you pull up a 10-year chart of the S&P 500, you can see how it's moved. Dips during tough years like 2020 and 2022, but an overall steady climb upward over time. That smoothness is the entire point of diversification. Even during the 2020 crash, when markets dropped over 30% in just a few weeks, the S&P 500 recovered all of its losses within about 6 months. A lot of individual stocks took years to recover, and some never did. Let's talk returns. Individual stocks have the potential for much bigger gains. If you bought Amazon or Apple stock early on, you could have seen returns far beyond what any ETF could offer, sometimes turning a few $1,000s into life-changing money. But that same stock could just as easily have gone the other direction. And for every story you hear about someone getting rich off one stock, there are far more stories of people who lost most of their investment betting on a company that didn't work out. ETFs won't give you that explosive upside from a single winning stock, but they also protect you from a single company tanking your entire portfolio. Looking at the historical S&P 500 chart, you can see it's returned about 10% per year on average over the last 3 decades. Not flashy, but remarkably consistent year after year through recessions, wars, and recoveries. There's also a cost difference worth mentioning. Buying individual stocks usually means more research time, reading earnings reports, following company news, understanding what might move the price. ETFs require almost none of that. You're not researching one company. You're betting on the overall direction of the economy, which historically has always trended upward over long periods of time. So, which one is actually right for you? If you're comfortable doing research on individual companies, watching earnings reports, and accepting that some picks will lose money while others might pay off big, individual stocks can be part of your strategy. But if you want a simpler, lower-stress way to invest, one where you don't have to predict which company will win, an ETF like an S&P 500 fund is usually the better starting point. especially if you're new to investing. Most experienced investors actually use a mix of both. They build a solid foundation with ETFs for stability, usually the majority of the portfolio, and then add a smaller percentage of individual stocks they personally believe in for extra growth potential. That way you get the safety of diversification with a bit of upside if one of your picks does really well. A common approach is putting 80 to 90% into ETFs and the remaining 10 to 20% into individual stocks you've researched and believe in. So here's the simple takeaway. ETFs give you instant diversification, lower risk, and steady long-term growth. Perfect if you're just getting started. Individual stocks give you higher potential reward, but also higher risk and require more research and attention. Neither one is better. It depends on your goals, your risk tolerance, and how much time you want to spend researching. If this helped clear things up, drop a like and subscribe for more simple breakdowns like this.